Hi folks, Michael here. Ever wonder how traders turn small accounts into steady gains without gambling it all away? If you're just getting started and feeling overwhelmed, I'm sure, by the charts and jargon and strategies, then maybe this video is exactly right for you. And today, I'm going to break down for you guys 5 beginner-friendly trading strategies that are simple to understand, and they're also easy to practice, and they're just perfect for building confidence, right? So let's dive straight in. And before we dive into strategies, it's important to understand what trading really means. Okay, so on the one hand, we got trading, and on the other hand, we've got investing. Now, trading is different from investing. Trading is all about capturing short to medium term price movements in assets like stocks or options or even other assets as well. So that's a different thing than investing. Investing is long term. It's your buy and hold. You're thinking maybe of an approach that might be more suitable for retirement. Now, for beginners, risk management is crucial. It is key. And the best strategies are those that are consistent, they're also quite simple, and they're easy to evaluate. So for instance, we should be thinking about using a stop loss orders. Now, you want to check, and when you're doing your testing, you want to see how important stop loss orders and take profits as well are. Now, what is a stop loss order? Look, if you're buying at a certain level and you're going to profit if it goes up, but you're going to lose if it goes down, maybe you're only comfortable losing a certain amount. Also, if maybe you're shorting a stock and you're going to lose it the more it goes up, maybe you're only comfortable losing a certain amount. And also what's actually good for your overall profit and loss. So you might want to put in these stop loss that just sells both when the price starts to fall too much or when it goes above it too much if it's a short. Take profit is quite similar, but a stop loss, at least it's like Warren Buffett's first lesson is, first, don't lose money. And second, his second lesson is, remember lesson number 1, don't lose money. So stop losses are very good. Another thing you can think about doing, of course, is diversifying. So not having all your eggs in one basket, right? And looking at maybe different asset classes, different timing strategies, different stocks, if stocks is your thing, having different types of stocks, different companies, maybe even international exposure to international markets. Position sizing is something that's often under talked about, but look, you like the diversification, you don't want to go out and buy too much of one particular asset relative to your overall investing strategy. So for instance, if you're buying a security like Apple, you might not want to put 100% of your money into Apple. Usually a good rule is something like 1 to 2%. Not to be basically making trades that are more than 1 to 2% of your overall asset investing in terms of your overall positions. So your account, let's say it's 100,000, you shouldn't be spending more than 1 to 2,000 on a particular trade. Now it's the same if you've only got something small, right? If you've got something like $10,000 account, then you want to be kind of thinking about $100, $200 trades. Now, it's a little bit more different when you got a smaller account, but as your account grows, it's very important for this. You could look into a thing called the Kelly criterion that might help you in terms of your position sizing. And finally, you want to avoid emotional trading. Look, there's this kind of revenge trading. It's a little bit like what happens in a casino. When someone goes in, they start to lose. You know, the good times are good, but the bad times really suck. They're going to keep playing thinking they're going to win their money back until they've run out of money and they got to walk home. They don't even have money for a bus fare, right? So you want to basically maybe have a thinking about you can set up with your brokerage, you can set up a way of that if you lose more than a certain percent on a day, that you cannot place more trades, so to speak. So you want to try to avoid emotional trading as much as possible. That's where algorithmic trading really does help. And there's a great book on this by Nobel Prize winner Daniel Kahneman, Thinking Fast and Thinking Slow. Getting into strategies, our first strategy blends long-term investing with a simple trading filter, a little bit like a technical. Now, this is going to be something like where you only buy where the stock price is above a 200-day moving average. So moving average, we're looking at the price, and we're going to look at the price over the last 200 periods, right, in terms of days. So it could be that you only go into long positions when the trend is going up, right? When you're over that 200-day average. So to look at this and to put it into perspective, let's have a look at a particular chart here. I've taken this chart from, for instance, my trading view, and I'm looking here at the SPX or the S&P 500. Now we can see in white, this is looking at the S&P 500 one-day closing. So all these small little ticks are basically 1 day, right? It's falling, it's going up. Now you can sometimes see them in red, these candles, when they're going down, and green when they're going up. And also you can see these wicks where the wick, if it goes up to the top, it means it's the high point. When it goes down low, it's the low point. Now, one little tip that I would recommend people doing to really get some alpha is to potentially turn off the colors when you're looking at a brokerage. So for TradingView, for instance, I put everything into white, and it's amazing how that makes me less emotional when I'm trading and looking at things, right? It's a really big tip. I'm not seeing reds and greens, and it's amazing again how less emotional I become, and emotion is not generally good for trading. So here with this moving average, the blue line is a simple moving average. We're not weighting more recent periods. So we're looking at the average price over the previous 200 days. Okay, and as the market has gone up over time, this average blue is going up over time. It's kind of stabilizing there March, April, May 2025. So this was around the dip in the market there, January, February, really from February onwards. Whereas back here in 2024, in November, right, at this point, the market was just dipping at the first. It went underneath the SMA 200, and then after that, it rose above it. So it's been above it from around about November 2024 through March 2025. So because of that, we could think about, well, it's an upward trend, and you may not want to be going against the trend or counter trend. So this is going to help you to stay, right? This whole point, this first strategy is hopefully going to help you stay on the right side of long-term trends. It is very easy to set up with most free charting platforms, just like this one, TradingView. So again, what's happening here is at this point here in green, from there on, right, we're above, we're coming from below, we're going above. So in this little period here, just before that, we might think of potentially shorting or selling. Whereas from here on, we're thinking about only buying positions. Now, it could be that there's other things you're going to use as indicators to buy, but you might think, okay, when the market is above the trend, it might be more probable that it's going to keep going up. So we may only want to get involved with buying strategies. Whereas here, okay, it really was crashing quite a lot in February and March, and this had a lot to do with the uncertainty that was created, for instance, with trade policies, protectionism, under the Trump administration. So there was a lot of shocks and uncertainty in the market, and we can see that the price of the S&P 500 went under the 200-day moving average. And it has, apart from one or two blips, it has remained under there in April and into May. So we could think about here, maybe the trend is to flat or go down a little bit. So maybe we only get involved with short trades until it breaks out and goes above the blue 200-day moving average. We're not going to think about entering any long trades or buying anything because we're basically going against the cycle otherwise. So we're following the trend up, and then we're going down with the trend when it's falling. So short trades only necessarily from this to the right at that point. This is just one strategy, simple strategy you guys can think about using, and hopefully you get some alpha from that. Now, next up is swing trading. This is one of my personal favorites. Look, I don't really have the time for day trading. So day trading, we're thinking about the maximum amount of time you want to hold something might be a day. Usually you want to get out of your positions by the end of the trading, by the end of the day. So usually you're talking about a few hours, a few minutes, maybe even less if you're looking at really high frequency trading. But day trading, typically it's a few hours. You're really looking at, you're not holding it for more than a day. You want to basically clear yourself before the end of the day because there can be some massive movements in the wrong directions for you overnight. Whereas swing trading, you don't have to be glued to your desk at the same amount. So swing trading can be basically a hold time of at least a few days to potentially a few weeks. Once you get into kind of around the year mark, you're really looking at long-term trading, which essentially is investing. So swing trading, this involves holding a stock for a few days to a few weeks, as I've said. And so as a beginner, you can start by identifying clear support and resistance zones. So let's define those, and it's probably easiest to do with a chart. So looking at this particular chart that I've drawn here on TradingView, I'm looking at a different asset class now, cryptocurrency, and in particular I'm looking at one of the blue chip cryptos, which is Bitcoin. You know, it's probably the blue chip amongst cryptocurrencies, the second probably being Ethereum. So here we're looking at BTC USD, so we're looking in terms of US dollars. So as I've drawn this just over a year with daily closing points, so we're looking at these white ticks now, the little white ticks, they are going up or going down. Now, a little bit of an alpha move here is not using the colored candlesticks. So the colored candlesticks, usually it's red if the market closed lower that day than it opened the previous day, or at least in terms of whatever the period you're looking at. If it's an hour, it means, all right, at the end of the hour, it was lower than it was at the start of the hour, if it was an hourly candlestick. If it's green, it's the opposite. It's higher. Oh, it closes higher than it opened if it was the start of the day, or start of the hour to the end of the hour, or start of the 4 hour to the end of the 4 hour. Green. The problem with using colors, I have found, and some others find as well, is that you're more emotional in terms of trading. So you want to reduce the amount of emotion as much as possible with trading. And so I like looking at these white charts here. Now, these little ticks, and hopefully that's going to be one of the things you can take away, if nothing else, is to try to convert the colors. Now, one thing here I've done here with the BTC USD is I've tried, and again, it's quite subjective, I've tried to define supports, right, at this longer time interval, at the higher time frame. So we're looking here at over the course of more than a year at the daily closing. So here I'm noticing that really from around about February, March of 2024, once it crossed over this line, it kind of remained above it there. It was sort of testing it here for at least a week or two at the end of February. And then you can see that since then it really didn't go below it. It did test it almost in July, definitely tested it here in August and again in September, but it never crossed above that was the floor of the support. In terms of the ceiling or the resistance, it never crossed above this point here in March, mid-March. Almost did in May, June, almost did again in July, August, and then in November, until it crossed it later in November of 2024. But once it crossed it, went into a new zone, and here again at the longer period where I'm looking at a few months, I've drawn this support. But when you look at it shorter, you could kind of maybe bring that support halfway up towards the resistance where it's touching the bottom of those wicks, right? That could have been the support. But I'm looking at it here just over this longer period. You can see that it was almost testing it in March, and it definitely tested it in April of 2025. In terms of the ceiling or the resistance here, it was really, touching it there at the end of 2025 into January and also the start of February. Now, what we've seen here in terms of the Bitcoin USD is that what you want to be doing essentially with this strategy is you want to be buying near the support. So that's when it's coming down here. So around about this point, maybe around about here as well, as it's coming closer and closer, maybe you want to buy around here, you want to buy around here, you might want to buy around here. And as it gets closer to the resistance, you might want to be selling it when it's getting closer to the resistance. So buying when it's down low, selling when it's up high. And again, you could actually define these zones like that. Maybe over here, you want to be buying it at these kind of points and selling it at the top points. Again, it's not guaranteed 100%, but if you combine this with the candlestick patterns, for instance, like bullish engulfing, where maybe the actual prior day it was falling, the red, but then the next day it's green and the green candle is bigger than the prior day's red. So in other words, it went up by more the next day than it went down the previous day. Right, it could actually be meaningful, or hammer. Now, I don't typically find that much meaning in those particular candlestick patterns, but some traders do use these kind of strategies like that, use the combination of candlestick patterns with these technicals. So beyond swing trading with support and resistance, right, which is our first strategy, we could think about breakout trading as another strategy. So our first strategy was buy and hold with technical filters. So our second strategy was swing trading with support and resistance. Now our third strategy is breakout trading. Now breakout trading is all about catching momentum. Look, when a stock breaks through a key level on high volume, it often runs. So it's almost like that pent-up energy, right? When it's consolidating inside those boxes that we just saw, after it breaks out, it finally goes. Now, you want to look for the price breaking above the resistance or the ceiling or below the support or the floor. For beginners, you want to focus on clean patterns. It could be like an ascending triangles or consolidation ranges. High volume confirms the breakout. So there's enough buyers in the case of breaking above the resistance or enough sellers in the case of breaking below the support. So you might want to set an alert when you can put this on your trading panel, or you want to also use a stop limit order to manage your risk. So looking at, let's say, for instance, the last chart we were looking at here, right, it really was crossing above. Okay, it was testing the support, testing, testing, and then finally it broke through here. Now, if the volume was pretty high on this day or around this particular time, it would be a good sign to basically get into that breakout. Also, if we were thinking about having a higher resistance here, in between the support and resistance here, it was testing it a few times along here. You can think of a line here. It was testing this all the way across until it broke at these periods. Now, looking at, for instance, another particular chart here, we could see that, you know, these are two lines here looking at this zone, and we can see the volume on the bottom. And the volume, you know, what's happening here on this day, right, is we're finally breaking out of the resistance. We're coming from below, we're going up, and you can see that volume spiking. So there's enough buyer green to basically push it way up above the price resistant level. So the consolidation range is basically kind of bouncing back and forth between the resistance and the support, the price support level on the bottom, the price resistant level on top. And we can see the volume surges as buyers are rushing into the stock at this point. And the breakout then forms as the price surges through that defined resistance level. So that's a good example there of breakout trading and volume spike. Now, moving on to something quite different now, as a fourth strategy, we're going to look at options, in particular beginner option strategies. One strategy being the covered call. Now, I know, I hear you guys, options might sound scary, but the covered call is a really friendly, beginner-friendly strategy. So how does it work? Well, look, you own 100 shares of a stock or an index, and then rather than just owning the stock or owning the index, you then want to also earn rent. Like you own a house, but you're not renting it out. So you want to earn rent on that house. You own a stock, but you're not renting it out. You want to basically earn rent on the stock that you own. So if you own 100 shares, like why 100? Because 100 equals one contract in options world. So when you have 200, you could have 2 contracts. So you can sell a call option against that ownership. This is not naked, this is covered. Because you own the 100 shares, you're not suddenly going to be rushed upon to sell someone shares. If you don't own the shares and the price jumps up theoretically infinitely, you could suddenly have to buy them at a huge high price. And that's what wipes some people out, is naked selling of call options. Here, what we're going to do is it just means that, right, if the price goes up above the strike price, the price at which you've promised to basically hand over your shares, if it goes above that rate, that level, well, if it goes above that level, at least you have the shares to give it away, right? So you're not going to be caught with nothing to give, and your account won't get wiped out. So you will gain the difference between what the price is right now of your shares and the actual price, the strike price. And if it goes any higher, okay, you won't get the extra upside risk. So you're capping your upside risk. So you're capping your upside return, but you're also lowering your limit, right? You're lowering your risk. You're not going to lose too much. And if it goes down, well, hey, okay, you've owned your stocks. The stocks are going to go down in value, but at least you earned a premium for actually selling the options in the first place. So this is a great strategy for earning and generating extra income, especially in sideways markets, right? When you own something that's going flatlining like this, like it's 2022 all over again, right? In that case, you may want to sell a call option that's a good bit out of the money. It's a good bit higher, right, in terms of the strike price. And that way you can earn some extra return even if the market is going flat. You're getting like 0% on average, but you're making some money, you're making some return. What is the risk? Well, the risk here is that you might have to sell your strike at the strike price when it goes up above that, but you're going to get your profit. So to illustrate that in a quick chart, we'll have a look at the covered call payoff here. So let's say the current price is 100, you're selling a call option for 105. Well, below 105, the person that you've sold the option to, it doesn't make sense for them to execute, right, on that option. So as a result, you're not going to have to do anything. You're just going to witness, right, you're going to witness that appreciation. The yellow dotted line here is if you own the stock. So at 100, it hasn't gone up, hasn't gone down, you've earned 0. If it goes down below 100, you're losing money, right? It goes down to 80, that's a 20% decline. That's a 20% loss. As it goes up though, you know, you've gone to 130, you've made a 30% gain. So that's if you're just longing a stock or just owning a stock. Now, by also selling a call, again, if you had no ownership of the stock, you'd be making this little profit here, the premium that you've earned from selling the call. But once the call, the price of the actual stock, exceeds the strike price, you could be asked to hand over that particular stock. So you'd have to buy 100, if it's one contract, you've got to buy 100 shares. Now it's at 105 plus a bit. So essentially what's going to happen here is you're going to buy at 107, you're going to sell at 105, so you're losing about 2, but you've earned the actual premium. But as that price of the stock goes up and up, eventually it wipes out the premium that you earned, and eventually you're going into negative territory. And this could theoretically be infinite, right? Because the price could go to the moon, and that way you're buying at 130, right? And you're selling at 105, that's a loss of 25. But of course, you're getting the little net gain from the premium. So it's not quite negative 25. It's like just maybe negative 22 if it was basically $2 of a premium. Now, the nice thing about a covered call that saves us is we don't get this theoretical infinite loss, but we are limiting the upside risk. However, we can see that the red, which is the covered call, it exceeds that. The only time that we're not doing as well is if the market goes to the moon, the price of the stock goes to the moon. Then we're going to be not doing as well, but at least we're locking in that profit. We're guaranteeing it if it goes above that rate. And if it goes down, well, we're not doing as bad as if we just own the stock. So we're doing better than if we just own the stock. So this is what's nice, a covered call strategy. Now, a fifth strategy is what's known as the cash secured put. You want to buy a stock that you love at a discount? Maybe it's the index fund, something like the SP, the Spider Index. Try selling a cash secured put. Okay, you got to sell a put with enough cash to buy the stock. So you commit to buying the stock at a lower price than it is right now, and you get paid a premium for it. If the stock doesn't fall that low, well, you keep the cash that you've earned from the premium, and you profit if the stock stays above the strike. If it does fall below the stock, then you can buy it cheaper at a discount if you are assigned than today's price. So let's look at that in a graph. So here what we're saying is that you're selling this particular put. So you're earning this premium. Let's say it's $2, 0 to 2. And a put is like insurance. So the person you've sold it to, you're saying that, all right, the price is 100 right now. If this stock drops below 95, I'm going to basically buy it from you at 95. Now, there's no way they want to sell it to you at 95 if they can get 100 or 110 or 120. It only makes sense for them to exercise this option, or you becoming assigned the shares, if the price of their stock drops below 95. So as it does, right, you're still in the positive to the extent that, well, if it goes to 93, right, you're still in the positive. But then, of course, you're owning the stock at this point. You've given them 95, but you've received the actual stocks, but they're falling in value. But of course, it's not as bad because you're given that amount, that premium that you've earned. So this is good if you think it's going to be a sideways market or if the market's going to go up. But it's also good if you're thinking about getting into something, maybe like the index fund, like, sure, I'd like to get into it, but I want it to be 5% lower than it is right now. I'm going to wait until it's 5% lower. So you can get these stocks or assets at a premium, at a discount premium. And the main thing about what makes it a beginner strategy is that you secure it. You have enough cash, right? Because you don't want to be caught out. If it's $95, remember one contract is 100 shares. So you must have 100 times 95 or $9,500 in your brokerage account so that you can buy at that particular price. And in that way, you are secure. No matter what the strategy, risk management is what separates truly successful traders from gamblers, and we don't want to be them. So the first thing you can think about doing is defining your risk tolerance. Would you be okay if you lost 50% of your account? Would you be okay if you lost only 10% of your account? How much could you lose and still sleep at night for? So that's really important. It sounds grand when the prices are going up, when the prices are flat, but we don't like to see things when they're going down too much. So it's important that you define your risk tolerance. So you've got to think through this, maybe a life experience, but it's important to define your risk tolerance. Also thinking about using stop losses. They prevent you from making an even bigger loss, right? Because if you're, especially with, let's say, smaller stocks, maybe micro caps or small caps, or more risky stocks, or some riskier cryptocurrencies, you could theoretically go to zero, right? And if you're doing some options trading and leverage trading, your risks could even theoretically be infinite. So it's important to use stop losses, defining a certain amount, like, okay, I want to get out. I don't want to get stuck in this trade and lose a huge amount. I'd rather redeploy some of that capital elsewhere. So maybe if I lose more than 3% or more than 5%, right, define them very clearly. And also your take profits. It could be that you're only going to risk 1 in the stop loss to make 3 in terms of your take profits. Maybe you want to let the actual stock ride up a little bit. But it's not really profit until you take it out to a certain extent. It's not realized, it's unrealized, especially with trading. Different, again, we're looking at investing and buying and hold for the long run. We're kind of sitting back and we're happy to see what happens. But when we're getting into day trading or swing trading, you really are trying to a certain extent to extract the money from the market. Especially with day trading, it's all about scalping or taking money out every day. So make sure that you have your stop losses and take profits set up, but do check, because sometimes it does make sense to use them, and sometimes when you test your strategies, it may not make sense to use them. Define your position sizes. Again, the rule of thumb could be 1% to 2%. Something like the Kelly criterion can greatly assist you when you're trying to figure out your optimal position sizes. You don't want to put too much too quickly into one particular asset or security. You want to gradually get into it. Again, it can depend. It could be like your dollar cost averaging, right, with certain things. Diversify your trades as well. Don't be going all in one direction or all in terms of one particular asset or one particular security. Avoid revenge trading, as I've mentioned earlier, and emotional trading. So you don't want your emotions to basically rule you in trading. It's usually the less emotional that do the better, right? They've done, there are some studies on this that I've heard about through, I guess at this point, it's almost like urban legend about the groups of people. I think it was Fidelity that were doing a study. I couldn't find the study, but I've heard about this. But, the people who did the best, right, were dead people. They forgot they had an account, right? They were dead. Or people who even forgot, they were like second best, people who were forgotten that they had an account, right? They're not mingling with it too much. So the less emotional you can be, the better. There's a reason why a lot of the index funds and things like that do so well versus active traders. Part of the reason why the passive works so well is because you're removing human emotion. And human emotion, a lot of the time, is counterproductive. A final thing you can think about doing is maintaining a trading journal. Why did you invest like you invest? Why did you trade? Why did you sell? Why did you buy? What are you waiting for before you sell? What are you waiting for before you buy? Being really, really clinical. You're going to forget about it. If you do this every day and you do it for a year or 2 years, you should do really well, because it's like going to the gym and recording everything, right? If you actually monitor yourself that well, that's a great way. You're putting yourself ahead of their game by doing a trading journal. Few people do this, but if you do maintain a good trading journal, you are going to be well ahead of the average trader. So Which of these strategies are you most excited to try? Drop a comment below and let me know. Look, if this helped simplify trading for you, I'd be so glad to hear that. So if it does, then just take a second, only a second, and hit that like button and subscribe for more practical guides. Maybe in another video, I might dive more deeply into technical indicators that every trader should know. Thanks for watching, guys.